So the lending world is changing, and we get a lot of questions every day about different kinds of loans. And one of the biggest ones is DSCR. What is changing with it? What is improving? Where are rates going and who's still lending? And that's what we're going to go over today in this video. So we want to go over the little different nuances. Each lender, there's so many different lenders and they each have their own DSCR. It's not like conventional conforming where there's one main underwriting guidelines. Everyone has their own. So we're going to go over that, how to calculate DSCR, because you should know exactly what it is and what are the DSCR requirements of each lender. Some will want 1-to-1, some will want 1-to-3, some will want 1-to-5, and some will even take less than 1. We want you to understand that so you know it. Before you even bid on a property, you know if it's going to fit in a DSCR. We want to make sure you have access to fast, easy, and cheap financing because leverage is everything in our world in real estate investing. Over half of your money is going to be made on the kind of loans, the leverage you use in real estate, and that's why we want to make sure you understand these different things about different loans. We're going to do a series on bridge loans and gap funding, all those things. You need to understand this because times are changing and they're going to change for the good as long as you have money and have the availability to purchase these properties and these discounts when things come about. So each lender has its own nuances. Some are going to have higher DSCR requirements. They're going to want a 1.3 instead of a 1 or a 1.15 instead of a 1. Some are going to want higher credit scores. Some will allow lower credit scores. Some will have better terms, better products. They're coming out with interest onlys. Some have 40-year terms. Anything to make your cash flow better, they're coming out with products, and that's why you need a few different lenders. Some will lend in all the states, some will not lend in all the states. Some will lend on VRBOs, short-term rentals, some won't. What we're trying to get here is you need to be able to be a master of who's doing what. We want to know who out there will do an 8-plex instead of a 4-plex, because a lot of them are limited to 4-plex. Who will lend in personal names instead of just a company? Who is lending now compared to maybe pulling back? Because what you're going to find out over the next 6 to 12 months is things tightened up, but they are going to tighten up more. So you have to be more active in finding your money for real estate investing. 2, 3, 4 years ago, lenders were knocking at your door. Now lenders, you're going to have to go out and find them. The ones who are still lending are getting more people inquiring than they ever have. So they're a little overwhelmed. Their money is running out too because they're not getting paid back as quick, especially on the short-term stuff. Get someone who can help you, an advocate, to make sure you're getting the best product for your deal and being set up for the future. Here's something that everyone should understand. Different lenders have different DSCR requirements. Some will go down to 0.75, which they call no ratio, which means your payments are not even covering your expenses. In some cases, people will do that, especially if you're refinancing a flip just to keep it for a while. You'd rather have some negative or some positive income. Maybe your payments are $3,000 and you're only making $2,500. That's still better than paying $3,000 on a flip that's sitting on the market. Most lenders in the DSCR world will require at least 1-to-1. That means everything you're paying out from your principal interest, your taxes, your insurance, maybe HOA, is covered by your rents. That's the minimum they want. The higher that ratio goes, which means your rents are higher than your expenses, the better the terms you could get. Some lenders out there require their minimum now is 1.2, which means you now have to have a bigger gap. And that gets a little bit harder. Rates are increasing. Rents are increasing some, but not that much. You have to be able to understand exactly what DSCR ratio they're using. Do your research, check out the lenders, and see what their minimum requirements are. So it's important if you understand what the lenders are looking for, like how do you calculate this? We're going to go over a quick calculation because all it comes down to is what are you paying out? Once again, what's going out for that property monthly? Your taxes, your insurance, your monthly mortgage payment, and your HOA. Does not include any utilities or property management. Those items you add up, and does your rent cover that? Is your rent at least paying for what it is? Things have changed, rates have gone up, so those have gotten a lot tighter, so you really do need to know that. What we're going to go through is how you calculate that. And if you don't like math, no big deal. We have a free calculator. All you really have to do is download it below, and we'll give it to you. So it's a great calculator. You can work it on any property. But let's look at an example. Let's just say someone has a single family property And most of these DSCRs can go up to 4 units, but let's just look at a single family property. What you need to understand is what you're putting out. What are your monthly payments? It's either going to be principal and interest or interest only, depending on what product you have. So let's just say that payment is $1,000 just to keep this simple. Then you're going to have taxes. Property taxes on this particular deal is $250. And then you have property insurance. So these are the things that are required to keep that property in good financial health. All those together, we have $1,000 on the mortgage payment, we have $250 on the taxes, and we have $150 on the insurance. All those add up to $1,400. Let's just say, for example, your market rents are $1,600. Here's what we do. The $1,600 when we're dividing is on the top. So we're going to put that $1,600 on the top, and we're going to divide it by the $1,400, your expenses. So your expenses are on the bottom, your profits on the top. We're going to put those two together and find out exactly what ratio this property has for a DSCR loan. So we see when we divide the income, the $1,600 by the $1,400, we get a DSCR on this property of 1.14. So now we know that we're better than the 1-to-1. The 1-to-1 is typically the minimum that most lenders require. Now, there are lenders out there, like I said, who require 1.2 to 1.25. But most lenders currently, 1-to-1 will work. The higher that number gets, the better opportunities you have for better rates. Because the lenders look at it like the more income coming in from the property, the safer it is, the better rate they'll typically give you. So let's just say the same property brings in $2,000 a month. So $2,000 divided by the $1,400, our DSCR coverage now is 1.42. The 1.42 compared to the other, you can see that you're bringing in more income. Your lender is going to see that you're bringing in more income. They're going to like that property even more. They may give you a little bit more loan to value, probably a little bit better rate. Anything that has a higher DSCR will get you better terms in the lending world. VRBOs are handled differently than your traditional loans unless you've had a couple of years of experience with that property. You actually have the income from that property. Most DSCR lenders will either count it as a no ratio, so your rates are going to be higher and your loan to values are going to be lower, or if it qualifies, they'll go off the market rents, the traditional rents that that property would get in that market. And if that qualifies, you're good to go. So if you're looking at a VRBO short-term rental, you just have to understand the nuances of that too. DSCR works. You just have to understand that some of them will not allow you to use any income and they'll do a no ratio, and some allow you to use the market rents as a traditional rent. As I mentioned before, you don't have to understand, you don't have to calculate, you don't have to know if that one's on top, one's on the bottom. We have a great free calculator below that anytime you come across a property, you can put in the rents, mortgage payments, taxes, and insurance, and it'll let you know what your DSCR is. So that is below. We're here to make sure you have the leverage options. Leverage is king in real estate investing. We look at it as it's over half of what makes real estate investing successful. Because you need money to purchase stuff, you need money to carry stuff, you need money to fix things up. So leverage is king, especially where we're going right now. We're going into a time where there's going to be great deals. So you're going to have to understand all these different products. What is a bank offering now? What are funds offering now? What are DSCR? What are traditional loans out there? That's where we're here to help you. If you have a DSCR loan or any other loan, just reach out to us. We'll leave our email below. Send us a deal. We'd be glad to look it over. Make sure that either we can help you or we'll find someone that can help you, because we want to make sure you make the money you need to live the life you want.